Well, hello everybody. Welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well as we continue to hopefully ease out of lockdown. I'm pleased once again to have with me Jonathan Webster-Smith, who is the investment manager from Macdonald, who will be answering a few topical questions. Welcome, Jonathan.
Thanks, Brian.
Yeah. Okay, so a couple of more topical questions that I'd like to pose to you, please. Investment markets have had a good run of late, but it still looks uncertain out there. Do you think the volatility will continue?
Well, I think if we look back to the lows of March, and let's hope we don't retest those, we've certainly seen sort of sufficient government and central bank support to get us away from the fear that the health crisis was spinning into a financial crisis, and then the support has clearly allowed markets to come back from those lows. What we're seeing over the last few days, I guess, is really the market wrestling with the desire to go higher as markets reopen, and you would hope that corporate earnings would start to increase as businesses reopen. That would be the positive up step for markets. But at the moment, that's really been countered by perhaps some more negative health news. Areas in Beijing are closed down. Clearly, Russia, Brazil, America. I mean, you can name there's a few spots where COVID is coming back to levels that is concerning from a market point of view. So from the health issues, yes, I expect the volatility to continue. And of course, we shouldn't forget that we've got Brexit negotiations going on behind the scenes, and probably what does come more often as well is the US elections, and particularly US and China trade and the concerns around that. So I do feel the volatility is here to stay. I'll say the upside to me is going to be driven by people looking and seeing some positive numbers coming through in GDP, corporate earnings. That's perhaps what the market is looking for the next leg up.
Okay, and of course should be helped with businesses starting to reopen as well. Okay, the latest UK data looks poor along with much of the global data. What do you think this has in store for interest rates?
Well, of course, I mean the main data coming out from the UK was down 20. For the month, that's the worst month I believe we've had on record, which isn't surprising as everything shut and everything closed down, and there was significant retrenchment from an economic activity point of view. The result was that we saw significant coordinated central bank responses, which effectively we sort of go back to 2008 here and pulled interest rates very, very low or lower than the levels they were at. You could argue they were at low levels already. And therefore, I think the argument is that lower and low interest rates are here to stay. I mean, we've seen the Federal Reserve also indicate that they don't necessarily see interest rates moving. We've seen action from the Bank of Japan, and indeed most central banks around the world have taken that approach. And in the past, obviously the market's being a discount mechanism. If interest rates remain low again, that can be potentially supportive for risk assets, as you don't get much effectively if you keep it in cash deposits. So again, low interest rates can, along with the actions that central bank are taking, such as purchasing of corporate bonds and things, there is significant support perhaps for risk assets in that.
Okay. So good news for borrowers, but not such good news for investors is the outlook. Okay. With all the debt being issued at the moment, do you feel that debt levels as such are too high?
I think when we talk about debt, we really need to look at it. There's three main areas, or not individuals, areas that take debt. So there's the government side, there's the corporate side, and there's the consumer side. When we talk about consumer debt, effectively in March, what the evidence is showing that actually a lot of people are taking this opportunity to reduce debt. We actually had net debt repayment in March. But clearly, the longer this economic standstill is here, the more businesses, the more unemployment that we're going to see, the more that the debt becomes more of an issue. So at the moment, or certainly March and April, we actually have some positive news on the consumer side. And we should remember that post-2008, we've actually had, the debt that has been issued has perhaps been better quality debt, i.e. there's lower chance of default. But clearly what the lack of economic activity has put the risk of consumer defaults back into the arena. Businesses really fall, as it might be very simplistically, but if we do keep it simple, into two camps. Those that have raised money as a precaution, and therefore they're trading fine, the numbers look good, they've taken the opportunity to raise the money, there's no issue in terms of that debt. So although corporate debt is going up, some of it has been done as a precaution. There will be those companies, and what COVID has done is perhaps accelerate the process of companies that perhaps weren't viable longer term due to the technology changes all going on. The debt there is clearly an issue, and one would expect perhaps that default rates will start to increase in that area. So a corporate debt is a difficult picture. It really comes down to the sectors they're in, the level of debt the company's got, and indeed the sustainability and viability of the company. But certainly there are perhaps some areas that you would want to avoid. On other areas, actually, I think it looks an incredibly good value. What we've seen is yields go up, and therefore, to me, for some areas of corporate debt, you are being paid for the risk you're taking. So the caveat, we just need to be careful with the companies that we don't think are viable, but there's a lot have raised debts that are viable, and therefore that's quite an attractive option at the moment. Government debt levels are high. We've gone over 100% of GDP for the first time. Government balance sheets are very different to consumers, so in the short term, it's possible, and it shouldn't be raised too much or short-term concern, because the government need to spend money. If the government aren't spending and the consumer not spending, then the whole thing gets even worse. So we need the government to spend. That being said, debt at some point needs to be paid. World War II debt was repaid not that long ago, really. So when we say it's a generational debt level that's been raised from government, we really should bear that in mind. But for now, we need the infrastructure projects to come through, because that's what creates employment. The employment then creates consumer spending, and the UK and the US as well are very much a consumer-led economy. So government debt is high, and we need them to keep spending, I believe, in the short term. As and when tax receipts all increase, we are going to have the counter, which is at some point we need to stop the increase in government debt over time. So for the short term, it's gone up, and it's a benefit to the economy that it is, because it's creating activity where we need it.
Okay. So essentially, necessary action for extraordinary times that we're in. Okay. Last question, Jonathan, is we're seeing some talk about the US elections and Brexit. How do you position the Brunsdon funds for such key talks amidst the crisis that we're in?
I think, when we look at, the crisis we're in, but also we think back to 2000 and 2016, as obviously the Brexit, previous US elections around then as well. Politics generally plays itself out in the currency market. So clearly that's an area that we need to be aware of. We also come into what's done well around the COVID is clearly the technology. The more growth orientated companies have perhaps performed better, understandably so. Those that require positive GDP, more value type stocks have clearly lagged. But we've seen over a period, just 2 weeks ago, we had a significant rally up of value-based assets, simply as the market became more optimistic about the economy's opening up. So the answer to the question is, in these times where volatility is high, we need to be very diversified in what we're doing. So how do we manage it? We've increased the number of funds to make sure that we've got the right exposure in the right parts of the market, that we want to make sure we're not overexposed to any one particular area. And we take a sort of risk on or indeed a risk off if that's the view at the time. But for us at the moment, we still very much favour longer term equities, except the short term, the volatility will continue. And we're looking for increases in corporate earnings, and as we see that come through, then we can reposition. But at the moment, with the US elections coming up, we've seen some particular strength in the dollar, and also with Brexit negotiations. So we've got a lot of our exposure to international equities, and that's unhedged at the moment. So that's an area that we have to watch. So the key is to be active in these times and make sure that your positioning is diversified.
Okay, thank you. So steady as we go and active fund management. Okay, so I'd like to thank Jonathan for his input there, and I'd also like to thank you very much for watching. Hope that was of interest to you. As always, if you have any questions at all, then please be in touch. See you next time. Thank you.